The crypto world is notorious for its risk and its unpredictability. And this past week has seen both of these features surface in a big way as the Terra ecosystem has collapsed upon itself, losing investors billions of dollars. What happened and what can we learn from it? Today, we welcome podcaster and author Brad Mills to the show to discuss in detail the warning signs and the end result of this digital Ponzi scheme. Brad called it accurately back in January, and he's got a lot to say about Bitcoin, DeFi, Jpegs, centralized exchanges, and more. In fact, if we didn't end the interview, he'd still be talking. But it's all worth listening to, and you won't want to miss a moment of it. It's an extra large family size, you might be a lunatic, episode number 608 of the Bad Crypto Podcast.
5, 4, 3, 2, 1, 0, ignition.
Who's bad?
You might think I'm crazy, cause I bought Luna. I actually had a little bit of Luna, Travis.
You did?
Yep. I lost. I don't know how much I lost, but I lost. But
Yeah.
The crypto markets are down so much, and you're losing everywhere. So it's like,
Yeah.
okay, it's all part of the same mishmash of
It's true.
wins and losses. The goal is to have more wins than losses.
Yeah. Well, what's funny is about 16 hours ago, the price of Luna was 0.00000000999, and it is actually up 8,830% since then. And I actually bought some Luna, not quite at that all-time low, but I'm actually up a little bit on my Luna.
Nice. You are a lunatic.
I'm a lunatic. Not too many people at this point can say they're up on Luna.
Mm-mm.
But I did buy some at like two or three Satoshis, and now it's like 20 Satoshis. So
Nice. Cash it in while you can, Sir Lord Travis. Take
Yeah,
the money
no
and
joke.
run. So you discovered Brad Mills, although other people had previously discovered him because he hosts a podcast called Magical Internet Money. And he called this back in January. You spotted this information in a video you were watching about Luna. And I thought, okay, we got to do a show on this. Let's get somebody on who knows stuff, because, you and I were bad and neither one of us were deep into the Terra ecosystem. I had some money in it, but I didn't really know what I was doing. I was just being a lemming and following along. So this is a long interview, Sir Lord Travis. Like, we talked for, I believe it's like an hour and a half, and it is
Yeah.
packed with content.
well, I mean, I was there for an hour and a half. You were there for about an hour.
Yeah.
We locked it down. Let's see if you noticed when the moments when Joel actually had to go do some delivery stuff, which is funny.
Yeah.
No, it was great. It was like a chat and a conversation. It wasn't so much more of like an interview as it was an ongoing conversation, probably more candid and conversational than usual. But I tell you what, Brad's really smart on a lot of this stuff. He is a Bitcoin maximalist kind of guy, but he has called a lot of things very accurately. And he called, what could happen with Luna. He predicted this back in January. He saw this with the rebase tokens when those things went down. And he's called a lot of things pretty accurately. He's got his own podcast called Magical Internet Money Podcast. Really sharp guy, and really covers a lot of the bases on what all happened on this.
Indeed. So we invite you guys to listen in, settle in for this interview with Brad Mills. And on the backside, we're going to tell you about something we'll be launching soon called the Bad Crypto Nifty Club, after Brad gets done crapping on NFTs. Enjoy. Well, if you're not living in a cave, you are certainly feeling the tremors from the crash that happened this past week. And even if you're in a cave, even if in a cave, you're likely to feel the tremors, because aftershocks, damn it. And as we surveyed the landscape for who had the inside poop on what happened with Luna and UST, we discovered one gentleman by the name of Brad Mills, who's actually a longtime listener of the show, go figure. And his Twitter is Brad Mills Can, which I thought initially it was a Brad Mills scan, like we were going to look for Brad Mills. No, it's Brad Mills Can. I figured, oh, because he could. Then turns out he's from Canada. Eh? So he's not wearing a toque today. Yeah, hey there, but he did bring his Canadian beard to the show, and he's going to tell us all about what happened there with the Lunas and the Usts. Hey, Brad, welcome to the Bad Crypto podcast.
Oh, thanks for having me, eh?
Yeah, hey there. That's good, man. Do you, I got some people up in Canada. Do you know Marvin? Because you guys.
Oh, yeah, he sells the igloos.
Yes. That's the guy. All right, so it's been a
That's
hell
my
of
cousin. My cousin Marvin.
You're all related, right? Bunch of inbred Canadians. That's what they are up there. So I don't know where I got the Scottish brogue from. That just came out of nowhere.
Nova Scotia. That's Nova Scotia.
That's Nova Scotia. All right.
Quick-witted Brad Mills.
Travis, you actually discovered Brad from.
I did, and I signed into my label, and we got some mixtape coming out. We're dropping some serious beats. He's got the headphones right there. We're ready to roll. We're gonna do some rap battles here today for you and talk about the craziness, the lunacy. That needs to be the DJ lunatic. And what a crazy ride we've had this past week. Really, over the past month from watching Luna. You thinking about this 1 month ago, Luna, $80, $85. Today, 0.0000009 cents. It got even way lower than that earlier. Actually, the 0.00009 is actually up about 8,000% from its all-time low about 16 hours ago.
All right, let's start with this then. What is Luna? What was it intended to be? And so there's a ticker for it, Luna, and then there's UST, which is their alleged stablecoin, which is unstable. So what was the plan, and then how were they going to execute on it?
Well, okay, so it didn't start off as a Ponzi scheme, but it ended off in a horrible quantitative easing explosion. There's 2 puns. That's all the puns
really
I have
good.
today.
Those are nice. It made me snort, actually, which is very rare.
A Ponzi scheme.
Oh, very nice.
Yeah. Well, okay, so if you kind of go to the last cycle, the 2017 ICO bubble, there was a project coming out of Silicon Valley called Basis. If you recall that one, they did this massive ICO pretty much at the top of the last cycle, and Basis was going to be this algorithmic stablecoin. And the way that an algorithmic stablecoin was, it was like a solution to the problem with traditional stablecoins. Like Tether, USDT started off on Bitcoin on the Omni layer, and Tether was created by like Brock Pierce and Craig Sellers and some of these folks from Bitfinex, Phil Potter and those guys, and they kind of like they were getting pushed out of the US banking system in 2013 when the DEA, or the district attorney of New York, went after Bitcoin. So like Katie Haun was the chief prosecutor for the corrupt FBI agents in the Silk Road case. And it started off that she was tasked by the DA to go after Bitcoin in 2013 because Silk Road was being used to like circumvent the US drug laws, right? And so she quickly realized that she wasn't able to go after Bitcoin. And so the politicians in charge of that witch hunt basically said, well, go after the businesses, whoever's involved, go after the businesses, shut all the Bitcoin businesses down. And from that, we got Katie Haun ended up becoming a lawyer for Coinbase and LP in A16Z crypto. So she became a partner at Andreessen Horowitz and ended up making like $80 million off the Coinbase IPO. So,
but she was previously part of a government agency in some way.
Yes, they all are. That's why, there's lots of like conflicts of interest from government to crypto regulation. And
that's great.
And then,
hey, go shut them down. Go work for Coinbase.
Well, she ended up doing her job, like prosecuting the corrupt FBI agents, because it was actually not Ross Ulbricht that put a hit on somebody. That was all like faked by these 2 corrupt FBI agents that were, they like got the account and faked a hit. And anyway, so she prosecuted them. That never came out in the case because it was like kind of kept quiet. But so after that, like Bitfinex was the biggest exchange, and they had Tether, and they were being pushed by the government. The government was trying to shut down Tether and or Bitfinex. So they lost their bank accounts. Bitcoin companies couldn't get bank accounts. So the Tether story actually is the first stable coin, and it came from the need to have the ability for traders to have a tool to be able to go between Bitcoin and dollars.
And what
because
ballpark, what year was this, would you say?
2013, 14.
Okay.
So it's like first big crypto bubble, right? Before Mount
Mhm.
Gox collapsed, but it was like the run up to $1,000 kind of a thing. So that's the whole reason why we had stable coins, because traders needed a way to trade into dollars, and the US government and the New York state were like pushing Bitcoin companies away and going after them. So it was a very adversarial environment.
Mhm.
So they created this thing where it was like, well, we're just going to make blockchain based dollars. And it was a Bitcoin. It was riding on the Omni layer on Bitcoin. So that's a 1-to-1 pegged at the time. It was 1-to-1 pegged, right? And so that thing had usage for quite a while. It took about 4 or 5 years before that grew to $1 billion. UST grew to $1 billion in less than a year. It was like 6 months or something eventually in this bubble. So the Tether was this useful tool for traders. And eventually Tether grew to $3 billion in, at the beginning, I think of the beginning of 2020, Tether was about $3 billion. And it came out that Tether was actually not 1-to-1 backed. And that's what caused all the Tether FUD. You guys are probably familiar with all the Tether FUD, right? Tether's a Ponzi scam, and Tether's printing money from nothing. And Tether's got exposure to Evergrande Chinese bonds. It's going to blow up.
And here it is at $80 billion now.
Yeah. So like Tether at the time was pushed out of the US banking system. So they actually there was some fraud perpetrated against Tether because they were using a shadow bank overseas, and the guy that owned the shadow bank stole $700 million and bought a football team. So like Tether actually was not 1-to-1 backed at that point. They lost 30% of the backing, and Bitfinex gave Tether a loan. So then it was 30% corporate paper backed by Bitfinex and 70% in dollars. So it's just like, eventually they paid it off and it became 1-to-1, but then they became so big that they started acting more like traditional money markets and banks. And they instead of being 1-to-1 back, where it's like $1 in a bank account equals 1 Tether, they did what every other institution does in Wall Street and all over the world. They don't keep all the dollars. They buy US treasuries and other government bonds type instruments and hold the value of cash and cash like equivalents in custodial accounts. So Tether is kind of operating like a shadow bank at this point. It's not $1 equals $1. It's $1 worth of US treasuries equals $1 on the Tether
now,
blockchain,
was that in a partnership, you think, with the US government? Because like, hey,
No.
take some of those dollars and buy US bonds, because who buys US bonds and treasuries anymore?
No, it actually was like kind of an adversarial thing. Like the Tether's always been kind of looked at as pirate money, and they've been the most supportive of the Bitcoin ecosystem of all the stablecoin and crypto companies. Tether's been the most aligned with Bitcoin. The big competitor that came up in the last cycle was Circle, USDC, and they are Circle works directly with regulators and companies like Visa and JP Morgan, and Circle is like completely integrated into the Silicon Valley, Wall Street, pipeline. But Tether actually is kind of like the biggest stable coin. So the risk of Tether is that what if it's not backed, or what if the government goes after it? So there is no censorship resistance in using Tether, right? Like Tether is just dollars in somebody else's bank account, and USDC is just dollars in somebody else's bank account. So some crypto influencer guys and some VCs and some devs decided, well, we're going to make a stable coin that's not backed by dollars in someone's bank account, because then Bitcoin is government resistant, it's censorship resistant. No, there's no middleman with Bitcoin. You run your own node, own your own keys, validate your own transactions. That's blockchain native, right? If you own your own keys and run your own node, the Bitcoin doesn't go between you and a bank or any third party. It's you and the network, right? They wanted to create something that was like that, where it was blockchain native, that could ride on a blockchain, that had no centralized point of failure, in that it was not able to be like dollars in someone's bank account that the government could seize. So they decided
this is Luna that was trying to do this, or this was Coinbase?
Well, actually, it was the founder of Luna. It was the founder of Luna in 2017. They created this concept of basis, and basis raised basis cash. Basis raised like think it was $50 million in an ICO. It was mostly Silicon Valley people and Bitcoin and crypto VCs.
And
And
this
then
was
the
Do Kwon,
SEC,
right? But he was
Do-
part. It was part of
it,
that basis.
it just came out recently after Terra Luna exploded that this was Do Kwon involved in that.
Oh
We
wow.
didn't know that up until just recently.
Oh
So
wow.
so what happened in 2017 was they raised a ton of money and then the market crashed, right? You guys remember, obviously, we went from like January 2018 at like all-time highs and all this stuff to just completely destroyed within a matter of like 6 months, like down 90%.
90% of the markets were even Ethereum went from 1,500 to like $150 or something.
Exactly. So Ethereum's gone down. Like people had invested in this ICO at like $1,000 Ethereum, and then it's down at like $100 at this point, and they decide, well, because the SEC says this stuff is all legal securities, it's too much regulatory risk to do it in the United States, so we're just going to refund everybody. And they refunded everybody back at the value of the current value. So people even that got refunded lost 90% because they gave them back the money at the current value, not the value it was at the time of the investment.
Well, hey, one Bitcoin is equal one Bitcoin. One Ethereum is one Ethereum, right?
I mean, you can validate that one Bitcoin is one Bitcoin. I don't know if you can validate that one Ethereum is one Ethereum. I have to wait and see on that one.
No joke.
I don't know if you can run a node.
I'm curious about this guy who bought the football team. Did he get busted?
I don't know what ended up happening with that guy. I think so. I think in the end,
how the hell do you launder $700 million to buy a football team with stolen money and not get punished?
I don't know, man.
What football team did he buy? Because I want to root against them.
I don't know. I'm sure we could Google it, but like if you read, if you read the book $1 Billion Whale, I mean that's the whole story, man. The billions of dollars got laundered, and like the Hollywood celebrities were all involved and stuff. There's a lot of crazy high level scams and schemes that get perpetrated, and people don't end up getting punished that much because it's like they do it in a gray area way, protect themselves with anonymous trusts and all this stuff, right. And they ended up beating it in court and paying people off and settling. And in fact, it was the U.S. regulators actually didn't help Bitfinex recover the money. They were actually more aggressive towards Bitfinex for allowing for not like preventing getting the money stolen. I mean, the whole history of Bitfinex and Tether is just like the government's been extremely adversarial and against them the whole time. So that's why a bunch of Bitcoiners kind of like don't recommend people use Tether, but kind of also defend Tether. Even though we don't like Tether, we understand that they've been preyed on by the government for so long and pushed towards these shadow banking relationships. But anyway,
I want to ask some more about that here. Actually, I'll just go ahead and ask it now, because you say that USDC has been, with Circle has been working more, with JP Morgan and Visa and some of these big organizations, whereas Tether's been kind of pushed out. I was just Joel and I were actually having a conversation with a business partner of ours who seems to think that, UST was targeted, and we're going to talk about that, BlackRock and Citadel and how they borrowed all this Bitcoin. We're going to get into that. But like, what do you think some of the other USD coin, US stable coins are in danger? Do you think is Tether going to have a long-term run, or do you think the USDC maybe has better potential long-term?
Well, I don't think that USDT actually did have a run 2 days ago, and it already repegged. Like it went down to 95 cents overnight when the night that Luna completely collapsed to like below $1. There was also a bunch of activity in the OTC desks from some of the biggest OTC brokers that sell calls and options. Like basically they allow people to short whatever, and they received a whole bunch of people shorting Tether, and then it did depeg. It went down to 95 cents, and you can see in the DeFi pools that the curve pool, the main curve pool, which is like the pool in Ethereum DeFi that allows you to have fungibility between USDC, USDT, and DAI, which are the three main stable coins in Ethereum DeFi. Somebody had drained the pool of all the DAI and USDC and just left the pool full of Tether. It got up to like 92% Tether. It's always supposed to be 33% full of each one, so that you can go in and edit it with fungibility and have the $1, $1. Somebody was attacking Tether 2 nights ago, and they created conditions that were primed to have Tether depeg. It did depeg. Somebody made a boatload of money on those shorts, but because Tether is not a Ponzi scheme like USD was, it repegged. So there's not as much of there's like minimal risk of Tether exploding like UST did, and same with USDC. And there is risk in things like DAI and Magic Internet Money, MIM. Like there's risk in those things blowing up, but the most extreme risk is still in the other like algorithmic projects. So that's what Basis was, right? Basis was going to be an algorithmic stablecoin where it's a blockchain native asset. So you collateralize it with a coin, not with dollars in someone's bank account, but with a coin, and it's over collateralized. Right. So MakerDAO was the first deployed algorithmic stablecoin, and MakerDAO has the coin DAI. Now, I don't know what moron came up with that term. Like, you're going to put your money in DAI? Like, okay.
I'll put my money in live.
Yeah, I'm going to put my money in DAI. I'm going to hold all my money in DAI. It's like, who came up with that stupid term? I don't know. It was
like digital asset investment or something. DAI.
Decentralized autonomous integers. I don't know what it stands for, but
yeah.
It's DAI, and basically, like in the MakerDAO model, you put in ETH over collateralized by 3x. So if you want to have if you want to mint $100 worth of DAI, which is meant to be $1, then you put in $300 worth of ETH in the vault, like the CDP vault, and then as long as ETH doesn't collapse by 66%, then you're fine. But the moment it goes below, so the moment that $100 now goes below, that means that you get liquidated. So that you just lose your money, and somebody else, kind of like the protocol, earns fees, and the people that are like providing the market making service on that complicated DeFi backend stuff, they make money arbitraging it and all this stuff. But basically, it's like a simple thing of like, you over collateralize it with ETH, and then you get DAI that then you can go and use in DeFi stuff, or deposit in a farm or whatever, earn yield, or just hold dollar value. And the idea is that like that model allows people that want to create an algorithmic stablecoin to use in Ethereum apps and trading NFTs or whatever. They can do that in a way that it's not at risk of centralized seizure, so that there is no bank account that can get seized in that model. The problem with that model ended up being that nobody was really using it. It was only being used by smart contract developers and like VCs that had built the project and invested in it. It was not really being used.
Yeah, well, we talked about it sometime where somebody had like borrowed a bunch of DAI or something, and then did some stuff all in one transaction, and then returned it all back, and then made a whole bunch of money because there was like vulnerabilities in the smart contracts, right? So there's been some instances of some crazy shit that's gone down with this.
Yeah, the flash loans, like that's part of the MEV and flash loans and stuff like that with Ethereum DeFi. That's why it's so risky, that it's like the dark forest. Like there's always like thieves around your path that are just going to rob you. They can see what you're doing, and they know that they can make money by front running you and like flash loan exploiting you. So it's extremely dangerous for people to be trying to use Ethereum DeFi, as we've seen over the last year, all the hacks and all the explosions and everything.
Right.
But just the concept of like MakerDAO was not as risky. It was risky because what happened in March 2020, when the markets crashed, MakerDAO was about to explode. Like the Ethereum price crashed so much that it like MakerDAO basically broke. And Andreessen Horowitz, who's like one of the biggest venture capitalist funds in the world, they're like the most influential in Web 2.0. They own, everything. They're like the godfathers of Web 2, and they own the surveillance network that is the internet currently. They are heavily investing in this Web 3 stuff because they realize that they have a chance to just like redo the whole thing and get rich again. And like instead of it being
vulture capital, baby.
Yeah, I mean, it's like Web 2.0 is you are the product. Everything's free. You are the product. Web 3 is you are the pre-mine. Like you're the exit liquidity for the pre-mine. They own it all already, and nobody's even using it really. Like there's not that many people using Web 3 compared to Web 2. and already the same people that own Web 2 own Web 3. So it's kind of silly when they try to push this narrative out there that it's like for the people and all this stuff. It's like, no, you're doing exactly what you did in the previous 10 years, but you've already done it. You've like usurped Web 3 before it's even had a chance to get out there. And you're already like making billions of dollars on it. So it's just funny watching that happen. But so they own MakerDAO pretty much. Like they're one of the most influential groups supporting that. And what they had to do, and a couple of other whales and funds, they had to actually put a whole bunch of USDC into the MakerDAO protocol, right? Because it was going to blow up. So in March 2020, when we had that significant crash, MakerDAO was at risk of blowing up, just like UST just blew up. So they propped it up with USDC. So because USDC is like $1 is $1, right? And they're super integrated with the US banks and stuff. So USDC basically like over half of the value of the DAI currency right now is collateralized by dollars. So in my opinion, and in most people's opinions in Ethereum and all these other cryptocurrency DeFi things, they look at DAI as a failure because DAI, they had to like cheat and like save DAI by backing it with USDC, which is dollars in someone else's bank account, which is not censorship resistant.
Right.
So then,
and just as an, oh, by the way, folks, if you're tuning in, it's we did interview Stephen Becker, I believe one of the founders of MakerDAO, back in episode 442 of Bad Crypto. We had a conversation with him about that and was described, was talking about, it was in like 2020, September 2020 when we interviewed him, had him on the show.
So like a lot of people in DeFi, like some people that aren't necessarily like Ethereum maxis or whatever, like they decided that, well, MakerDAO is kind of a broken solution now, so we're going to create another one. And then two more got created. One of them was Terra Luna, and one of them was Magic Internet Money and Abracadabra. I don't know if you guys have heard of either of those. Like obviously you've heard of Terra Luna, but have you heard of Magic Internet Money?
Internet money.
We've been talking about that for years, but yeah, I've actually been on Magical Internet Money, and I was staking it, but I actually wasn't earning anything. So I think I was staking it incorrectly or something, but that thing took off there for a while. Luckily I got out at a good time. But so those two were created after DAI sort of was defunct and not working out.
I mean, it was still working out, but it just wasn't, it was no longer true to the original principle of creating a truly a blockchain like native uncensorable algorithmic stablecoin, because it was backed by USDC. So there's this community of Ethereum or crypto DeFi people that decided, well, we're going to call ourselves Frog Nation, and we're against the VCs, and we're like a bunch of plebs and anonymous coders and cypherpunks and all this stuff. And what they decided was they're going to fork MakerDAO, and they're going to create Magic Internet Money, and they were going to open it up so that anybody could collateralize it with any cross-chain asset. So what, you could put your Avalanche in there, or you could put your Solana in there, you could put your Phantom in there, like any of these EVM compatible DeFi chains. And
you have a podcast about MIM, right? Podcast MIM. Is that about Magical Internet Money, or just about Magical Internet Money, the industry?
No, yeah, I just have a Bitcoin podcast. I'm just a Bitcoiner, really. Like my podcast is all about Bitcoin, and the Magic Internet Money meme was like back in like the Reddit days. That was like, join us, Magic Internet Money. But it's just funny. Like I ended up contacting the developers. That's why I know so much about this stuff, because I was like, oh, that thing's called Magic Internet Money. That's funny. I had the podcast. Like I should go talk to them. So I ended up doing quite a bit of research on it and talking to them and messing around with it. But Terra Luna started at the same time, like late 2020. Terra Luna is launching. It's after DeFi summer, where the fees start to go crazy on Ethereum. They start to realize like this is unsustainable. Ethereum is broken for this type of activity. No regular person is going to be able to use Ethereum for like basic transactions, like sending an NFT or taking a loan or sending dollars around, because it costs you 10 to 20 bucks to do any kind of transaction, or like, play a game or open a pack or take a turn in a blockchain game. So everybody started doing this like other dApps on other chains, and Terra Luna decided, so Magic Internet Money and Abracadabra decided, we're going to start a multi-chain. We're going to start it on Ethereum, but it's going to be a multi-chain version of MakerDAO, where we can have MIM be the like algorithmic stablecoin for all the other blockchains. And we're going to create bridges to BSC and Avalanche and all these other chains and Phantom. And then we'll have like liquidity pools between all these chains. So it'll be like the multi-chain algorithmic stablecoin. At the same time, you have Terra Luna starting up as its own blockchain. And the whole point of the Terra blockchain was just to be the stablecoin chain. So it was like, we're going to do our own blockchain just for stablecoin activity. And they had like the mirror protocol and the anchor protocol and all that stuff. And, you know, in summer 2020, we had the invention of the yield farm, right? That's what caused the massive FOMO bubble to reignite in DeFi and in crypto, like crypto, not Bitcoin, but like crypto stuff, like Ethereum and everything else. It was the invention of this yield farm, because DeFi was actually being used before this, but nobody really cared. All the crypto people were still like on the exchanges, like all the crypto traders were still on BitMEX and Binance and Poloniex and like, you know, Bittrex and all that stuff. Like nobody was really using DeFi until the yield farm started. So the yield farm was like a honeypot. It was like a way to get people to put their money into the pools. When you put your money in, you start getting paid.
You love it. Like that's freaking awesome when you figured out how to farm and this DeFi yield and stuff like that. Truly is magical internet money like that. Like you knew that 2020 year of DeFi, baby. Like we knew that it was just crazy what was going on with all that stuff.
Yeah, that was like all the food ponzis and stuff, right? That was like the yams and
sushi swap and
sushi and kimchi and all the food ponzis. It was hilarious. Harvest Finance. But it was like Curve and Uniswap and all these like lending and decentralized finance apps. They started realizing that, oh wait, maybe it's not the technology that people care about. Maybe it's the earning, you know, the same thing they cared about in the last bubble, the like getting rich off of a token. So they decided to start putting that back in, because nobody was really using it. Like it was being a little bit used, but then once they started adding those like the perverse incentive of a token yield back into the equation, everybody started to come to it again. And so that's how Terra Luna, that's why I identified pretty early that Terra Luna had a risk of collapsing, because it was built on perverse incentives. Now, unfortunately, most people that like are in crypto since 2021 came in. I mean, I'm like kind of like an angry old Bitcoin maximalist on Twitter because I'm like, why don't you see this stuff as a Ponzi scam? Like it's so obvious.
Here it is, January 29th, 2022. Risks of UST collapsing seem very high. And then you go through the tweets. All these will be linked in the show notes, by the way, gang, that you can go take a look at this yourself. And you explained why this could be a bad thing, including Luna price will go down. And if we look right now, okay, so timestamp this, it is the 13th of May, 2022 at 2:45 p.m. Luna is 0.00009481, down 99.5%. Let's look at the chart to see just how dramatic it is. Oh, wait, that's 24 hours. Here we go. Let's get more dramatic. There we go. Up to $112, pretty much to zero. And then here's the UST. I'll refresh this to make sure we're current, which is supposed to be a stable coin pegged to $1 at 14.5 cents. Oh, dude, you called it.
Well, I did, and I'll tell you why I called it in January was because like this protocol I'm describing to you, Magic Internet Money, had some problems. And if you followed the way that the DeFi ecosystem grew, it grew based on perverse incentives of these DeFi yield farms. And these yield farms don't actually do anything fundamentally valuable. Sam Bankman-Fried was on a podcast recently, and he basically called it Ponzi scams. He basically said it was a Ponzi scam, and they know it's a Ponzi scam, but they're just hoping that the world decides that it was not a Ponzi scam so that nobody gets in trouble. But you cannot actually expect that the market won't come to the conclusion that there's nothing valuable happening in this once the punch bowl gets taken away. because the logic is fine in a bull market. When the Federal Reserve is printing $10 trillion to prop up every single market, and after March 2020, everything went up. NFTs became a thing because people were trying to get yield on anything. Pokemon cards went up in value like crazy. Watches went up in value like crazy. Shoes, people are buying shoes for like 10x the value they bought them from originally. And then it's like rich people do the same thing, but with properties and artwork and whiskey, fine whiskeys and guns and things like that. But like regular people do it with things like collectible cards and I guess like Charizards and stuff like that, right? So everything kind of like in this bubble, like our logical brain of like what's valuable and what we should be paying money for gets kind of suspended in a bubble. And that's exactly the DeFi, the DeFi market structure is. It's kind of like a thrill, and you get euphoric because you're making so much money. And then something happens that the rationality kind of like comes back into the market. And then everybody realizes, wait a second, this has just been some kind of money game we've all been playing. And as people start to look around and see everybody else starting to clue into it, you start to pull your money out of it and you start trying to take profits. And when everybody starts to panic because there's not enough liquidity to get it for everybody to get out, everybody starts to run for the exits. And when everybody starts to run for the exits and there's no fundamental value there holding the thing up, that's when it can just go completely to zero, like Terra and Luna are doing right now.
Complete tankage. I mean, we're talking historic BitConnect levels of tankage. And actually, I don't even think BitConnect tanked this fast. I was like, this thing was going down 99% a day. Like it was at $80, and then it was like down 99.9%, and then it got down to like $1, and then the next day it went down 99%, like 100%. Like I've never seen something go down 100% 2 days in a row. Like this is historic.
Wouldn't that be down 200%?
It's funny.
It's the way down. Like it was just the value of it, just insane how quickly it dropped.
And like honestly, guys, I think this is just the beginning. That's why it's important that we're having these conversations and that people hear this, because I have been saying this since DeFi summer 2020. I basically said that what these developers are deciding to do is build unsustainable Ponzi schemes on the back of unprecedented money printing that's causing us to suspend our logic and causing people to just go further out onto this risk cliff and try to get as much yield as they can. And everybody's just following the leader and doing this FOMO game. And once rationality comes back into the market, it's all going to explode. And they're so interconnected that this is contagion risk for all the other stuff. Like this fact that the tier 1 crypto VCs were all propping this up for so long, like Mike Novogratz from Galaxy and Jump Capital and like Arca Invest. Like there were so many big tier 1 funds that were propping this Ponzi scheme up that they've lost a shitload of money as it popped. And now they have these liquidity positions in all these other DeFi protocols that once they're going to start making economic calculations that at a certain, like they have to prop all this stuff up. And that's why they fought it so hard to keep it from depegging back in January. That's when I wrote the thread, because in January, there was another Ponzi scheme that exploded called Ohm. I don't know if you guys remember the Ohm Ponzi. It was like everybody on Twitter had like,
yes, we did.
Yeah, 3,3.
Yeah,
the Olympus DAO rebasing. That was the 3-3 thing where they for like almost 8 months, people were kind of drinking that Kool-Aid, thinking that this is the reserve currency of DeFi and 80,000% APY makes sense because we're all going to hold, we're all going to stake the protocol, sacrifice our money to the protocol. And if nobody sells, then it's great. It's gravy. We can sustain the 80,000% APY.
That's not human nature though. Human nature is to look out for number one.
That's exactly. It was built on a flawed premise of this game theory behind the prisoner's dilemma, which says that if you're like, in this prisoner's dilemma, and two prisoners there or two people are held in separate rooms and questioned by the police and asked if they should confess or not, or rat out the other person, then the optimal choice is like the third choice for both people, which is just to not confess and not rat out the other person, and then you get the best outcome. So in the staking kind of like Ponzi manipulation logic that they push forward with Ohm, it was that you had to bond your money into the protocol and stake your bonded returns and then earn that money and don't sell it. And it was like, that's 3-3. If we all do that, then we can make it. We're all going to make it. Like that was what was getting pushed out. And it worked for a long time. It got to the point where Mark Cuban was tweeting like about this stuff. Like Mark Cuban was supporting this stuff. And Tim Ferriss
we played around with it a bit because it was just like, whoa, what is going on with this stuff? It was an interesting experiment. And it's like, I'll put a little bit in here just to play around with it because this is some
Because I've been to Vegas before. I mean, you know.
Yeah.
But you know, who made the most money on these things was like the insiders, because they get in at the very beginning of it and then they're making like massive bags of money on it. And these funds like FTX and whatever, when they start adding these things to their exchanges, that sends a signal to the rest of the market that I guess this is good enough for me to trade. It's on these big exchanges, and they start making tons of money on the fees, just milking money from retail that are gambling on this stuff. But really it's contagion risk when it blows up, because you don't just have these things isolated anymore. DeFi is all about interoperability and bridging to other blockchains and like posting your staked thing in this farm to get yield and then taking your derivative token that you got from that and going and putting it over here and getting another 10%. So everything's interconnected. And so when they start adding like all these Ponzi-nomic lockup things to DeFi and making it all about making as much yield as you possibly can and then adding leverage to it through things like Abracadabra and an Anchor protocol on Terra Luna, it increases the risk that this stuff is going to blow up. And as I started learning more and more about this, I realized like this is exactly like what caused the financial system to explode in 1998 and in 2008. Because in 1998, there was this fund called LTCM, long-term capital management. And if anybody wants to read a really great book about like learning about the risks of the traditional financial markets, read the book Currency Wars by James Rickards.
That is an amazing book. I've read
awesome
that book. The history of how money's been manipulated over time and all the reserve currencies and the wars and how everything eventually gets repegged back to gold. And it's a great book. And, the exercises that they did at the Pentagon to sort of try to collapse other people's currencies.
Exactly. And so that's the point that I'm saying, like in that book, he talks about how he was the chief counsel of LTCM. And what happened was they were doing this just like in DeFi, just like in crypto, these really smart people, the smartest people in the room, like these like autistic nerds, like Vitalik and Sam Bankman-Fried that are wearing shorts and ripped shirts when they're on stage with presidents. You know what I mean? Like these guys that like, they're like the geniuses, right? Well, geniuses fail when exogenous things happen and they're so cocky and confident in themselves, they end up hurting a lot of other people. Because if you push this stuff too much, it's all going to explode. And what happened in 1998 was LTCM was making a boatload of money, billions of dollars, doing this sophisticated strategy of statistical arbitrage. And basically what that was using high leverage on government bonds to bet that like when you issue a new bond, sometimes it's cheaper than the old bond, or sometimes it's more expensive. And eventually they should peg. They should all be worth the same. So they're going to bet with high leverage that the peg will go back to like fungibility, you know, and that usually works if you're really smart and you have great algorithms. But what happened in 1998 was the bond that they were trading was the Russian debt, and the Russia defaulted. It went to zero. So they've got massive leverage on this thing that went to zero. So this is the black swan sort of thing that happened in the markets. And when that went to zero, LTCM went bankrupt. And that doesn't just stay contained to the people that were invested in LTCM, because actually James Rickards points out in the book that LTCM collapsing almost took down the entire financial system. They had to go to the Federal Reserve and meet with all the other global systemic important banks, because Bear Stearns and JP Morgan and Deutsche Bank and all of these banks were exposed to LTCM. They had positions and they owned money with LTCM. And now that LTCM was going bankrupt because Russia was going bankrupt, it was cascading over because everybody's over leveraged. So they had to actually meet with the Federal Reserve and the Treasury and like try to save the financial system. And they were very close to having to do a bailout like they did in 2008. But it was Bear Stearns that actually decided not to participate and actually wanted to get paid back. So they called their debts in. And that's why in 2008, Bear Stearns was sacrificed, because they didn't play ball in 1998 when the system was falling apart. So you fast forward to 2008, the same thing happens again. Everybody's over leveraged with this toxic derivative stuff, these collateralized debt obligations. And then what happens when you start to realize that this shit is all toxic garbage? It's not worth anything. You stop trading. You stop taking the other bank's debts. You stop, you just pull your liquidity out as fast as you can, because you realize that somebody's bankrupt. And I don't want to be the one holding the bankrupt debt to this other person was way overexposed in this bubble.
Yeah, when the music stops, you want a seat, right? That's
yeah, exactly. You want a seat.
By the way, you get a point for the use of the word exogenous. I think that's fantastic. I also comes to mind that Steely Dan, the band, were ahead of their time, because they were singing about stable coins, 30, 40 years ago, and they said, Peg, it will come back to you. So, the whole idea there was for it to be stable. But I have a question around this. Now, Do Kwon is coming out with the revival plan. What does this entail, and is it laughable? Is it possible? Tell us what you know about this.
Well, right now, I think what Do Kwon is doing is just trying to survive. I think like the idea that this can come back is kind of the same idea that like Bear Stearns would be able to come back after the bankruptcy, event in 2008, or that LTCM would be able to come back in 1998. Like the equivalent here is that Terra blockchain was basically Russia. Like when this thing blew up, because it grew too fast, it was exposed to magic internet money in January. And when the Ponzi's blew up in January, Ohm and Wonderland, they were massive. They were multi-billion dollars. When they blew up in January, it was actually exposed to Luna, because there was this strategy where you go from Anchor, where you're getting 20% APY, right, to deposit your Terra. So Anchor has this like honeypot where you're supposed to mint UST from the Luna coin to put into Anchor protocol to get 20%. So people were doing that, but then they realized, wait, you can loop it to magic internet money into Abracadabra and back to make another 20% and kind of add leverage. So then people are collateralizing more into Luna to mint more UST to put it into Anchor to then loop it back and forth and back and forth. And these DAOs like Ohm and Wonderland and lots of DAOs now that control treasuries, they're like degenerates trying to make money they're basically like decentralized LTCMs. They're like decentralized hedge funds trying to just earn money. So they were all doing this too. Ohm was doing it. Wonderland was doing it. The treasury managers are all trying to like earn yield in DeFi. So what happened when it blew up in January was there's only about $100 million of liquidity room to be able to actually get out of the thing, but it had grown to like $10 billion in January. So it's like this one small door to exit. And when people when people want the seat, like you said, when everybody wants a seat, there's only one seat, right? Like it's like only enough people can get out of that door before it starts to depeg. So the first person to get out in Ohm and in Wonderland and in Terra and all that stuff, the first person to get out is the person that's, likely to actually survive. And like you said, this isn't actually a prisoner's dilemma. It's capitalism. It's actually like whoever can make the most money wins. So everybody has like the GM thing and the community thing. But honestly, I feel like that's just propaganda pushed out there to get people to just hold as long as they possibly can, to hold the bag open for all these whales and insiders that are just milking everybody. So what happened with this thing was people actually realized that there wasn't enough room. So they start to panic and they start to sell. Because if you want to get out through the algorithm, it's a small amount. It's 100 million, right? Then the next door is the DeFi, the Curve vaults. Well, Curve has like magic internet money pegged with UST, pegged with USDT, and it's like 33%, 33%, 33%. You're supposed to be able to get like say $500 million worth of liquidity in those. So there's like a second door to go out, which is the decentralized door, the DeFi door. Well, the big hedge funds that are actually the whales that are propping all this stuff up, when they start to realize people are running for the exits in the first door, they take their money out of the second door before the retail people and the smaller people can get out. And then before you know it, you can't even get out of that door. So what do? They go for the big door, Binance, Coinbase, decentralized exchanges like Uniswap. And the slippage gets so big that people just start to panic and they're like, I'm going to take 50% off. Like, I'm just want to get my money out, you know? That's why it can go from $100 to zero, because at a certain point, it's like everybody freaks out and the Ponzi collapses and everybody just wants the money. Even if it's 10 cents on the dollar, people just get out. So at this point, people have had their lives completely destroyed by this Terra Luna project. I don't understand how Galaxy makes it out of this. I don't understand how FTX and like Jump Capital and all these guys that were propping this thing up saying it wasn't a Ponzi scheme. I really don't understand, like crypto, like, yeah, Novogratz, Crypto Man ran, Raoul Pal from Real Vision, like the co-founder of Real Vision was one of the main culprits of this thing.
For
So
those who are just listening, I'm showing a screen right now. Max Kaiser, who of course is as maxi as they get, no pun intended, says we're experiencing crypto's fourth great wave of conmen and grifters getting wiped out. And he said goodbye, Novogratz, Raoul GMI, Crypto Man Ran, and Stable Quan. I don't necessarily agree or disagree with him, but he is calling these people out, and you're not wrong. There's pictures here, you know, there's Novogratz hanging out with Stable Quan.
Oh, he got the tattoo of himself. Like, go down there. There's the tattoo.
Oh,
that's
wow.
Mike Novogratz. He tattooed Luna on himself. Somebody changed it to Laura.
That's hilarious. So I want to talk about what collapsed Luna was this big play by some very big whales, right? They borrowed 100,000 Bitcoin. They sold Bitcoin. I've read what happened. Like BlackRock and Vanguard are maybe at the top of this whole thing that collapsed Luna, because, you know, the government realizes, whoa, they can't take down Bitcoin network, but maybe we've seen some flaws in some of these other ones. Where's the biggest vulnerability? And I read that BlackRock borrowed a bunch of Bitcoin, converted it to UST, and then did this thing which collapsed. I don't know. Could you explain what ended up happening?
So honestly, Travis, like I think that's just people coping with the fact that they were in a Ponzi scam and they don't understand that it was a Ponzi scam. They still think that like people like me are just butthurt maxis that missed the bubble or something like that. And they're just like, it's hard to rationalize the fact that you were promoting a Ponzi scam if you were one of the main people with the moon in your name, right? If you made your whole identity about this thing and you had Raoul Pal from Real Vision, which is supposed to be this reputable macro trading service,
right,
promoting this crap, like the co-founder of Real Vision was like in bed with all this. And you had Mike Novogratz, who's celebrated by all the crypto guys, and like he's like
a blockchain hero.
Yeah, like that's why a lot of Bitcoiners are very like, we don't like Novogratz that much. I mean, he's a nice person, but he's promoting Ponzi scams, and he's causing, him and Raoul Pal and these guys are actually causing a lot of people to like think that these things are new innovative technologies. And that's why a lot of us are upset with them. And it can come across sometimes like we're just toxic maxis or whatever, but really it's that we've been trying to warn people about this for a year and a half. And we have people that are way more influential in the space, like lending their credibility to this stuff, and ended up getting people destroyed in the process. So there's like, of course there could, like I pointed out back in January in that thread, I have one of the tweets that says somebody's going to make $1 billion shorting this thing and causing it to collapse. So I identified back then that somebody could do like a George Soros style play, or like in that book Currency Wars, when they were wargaming how you could crash an economy and profit from it. Like that happens for sure. But
imagine screwing over that many people so you make more money. I got a question here for you.
But wait, that's not the point though. The point is that it was going to blow up anyways. The point is that they caused this thing to blow to grow to $18 billion, and people were going to eventually run for the exits anyways as the bear market sort of set in, and people start realizing like, wait a second, it doesn't make sense. I'm getting 20% APY on this Luna thing that doesn't even have any real value, and people start to want to go back into their bank accounts and take their money out. but there's not enough room to get out.
They
So
just
somebody,
hastened it.
they just
made it so
hastened it,
fast.
really. They just hastened it and made some money off it, but it was going to blow up eventually, just like Ohm and Wonderland and a countless other of these things did.
So this article came out from the New York Post on May 13th. Coinbase warns customers they may lose crypto if company goes bankrupt. And basically, if you read the filings, it says that customers could be subject to bankruptcy proceedings, meaning that if Coinbase did go bankrupt, then you can lose any crypto or cash balances that are in there. Does this put USDC also in the line of fire? And on a more macro question, are any of the stable coins, including USDT, actually reliable?
So in this case here, like, yes, any asset that's in your bank account at any exchange is going to be tied up in bankruptcy proceedings, not even if it's USDC, but even if it's just database USD on the balance sheet there. Like, the only exception to that rule right now is Kraken with Bitcoin only, because Kraken is got one of those Wyoming SBDI bank licenses. Like, they're basically like a real bank at this point with the Bitcoin holdings, which protects customers' Bitcoin from being tied up in bankruptcy proceedings. So, like, not your keys, not your coins, right? This is a story as old as time, with Bitcoiners been yelling this from the rooftops since 2010, 2011. Like, don't keep your currency on exchanges. That's why a lot of us Bitcoiners say don't use BlockFi, don't use Celsius, don't use Nexo and Crypto.com, don't use any centralized service that is telling you that they're going to give you yield, because as we know with Web 2, you are the product. Like, they're doing something with your Bitcoin to get that yield. And if you don't want to risk having it get lost and tied up in bankruptcy, or when the market collapses, maybe they were too exposed to Anchor Protocol. Maybe they decided they wanted to hold a big bag of Luna because Mike Novogratz tattooed it on his arm. And they figured, like, Jump Capital's one of the biggest trading funds in the world is propping this thing up with $300 million and then eventually $10 billion of Bitcoin, quote unquote. So it's safe. And then they're getting yield in that 20% Anchor Protocol. That's what these exchanges and some of these centralized exchanges are doing. They're actually integrated with these extremely risky Ponzi schemes. They take customer deposits and they put it in Anchor Protocol and get yield. And then they give you 10% and they keep 20%. So, like, there's serious contagion risk that this could affect centralized exchanges like Coinbase and decentralized exchanges, because there is no central bank of DeFi. Like, that's the thing that I pointed out in my article back, or my tweet storm back in January, that, like, unlike the traditional financial system, in both systems, it's like toxic, derivative, synthetic, risky things that don't have any value for society in both Wall Street and in DeFi. But at least in DeFi, I'll give them the credit that it's transparent. We can see when something's a Ponzi scheme and we can predict when it's going to blow up. In the traditional markets with the banks, the way that they're all opaque, and the Federal Reserve holds closed door meetings with the Treasury to bail out corporations and banks whenever they want, we can't measure the risks in the traditional markets. But the one thing that they have that we don't have in the crypto DeFi world is a central bank that can rescue it. So, like, Jump Capital and these funds that were coming up with the money to prop up these DeFi things and rescue them when they get hacked, like Wormhole Protocol got hacked on Solana for 300 million, Jump put in 300 million. Like, these guys are acting like the wildcat bankers of the 1920s. Like, the JP Morgan is named after a literal guy, JP Morgan. He was like rescuing banks and rescuing the markets when they were collapsing during the Great Depression. And he was calling for a central bank to be able to provide liquidity and provide trust and provide confidence when the markets were in turmoil. So that's why we ended up with a central bank.
He was actually behind even manipulating the downward turn to actually help them. And then he would bail them out to look like the hero to get the central bank that they wanted in the first place.
Sure, yeah.
The creature from Jekyll Island, baby. I mean, it goes way back to all of that. This currency wars and manipulations have been going on for a very long time. Well, before we get too far off of this, I want to actually share this one thing here, because Do Kwon was just on an interview just about 9 days ago, and he was talking about 95% of crypto is going to go down. So let's take a look and listen to what Mr. Do Kwon here had to say about all of that.
I wonder how many of these companies you think are entering the space just because it's hot and there's a lot of funding versus the ones that will still be here, like 2 to 5 years later.
Oh, 95% are going to die.
Yeah.
95% are going to die. Yeah. But yeah, there's also entertainment in watching companies die too.
There's entertainment. Oh man, that's so evil. At least you get to learn from it, right? I wonder how many.
It's entertaining watching these coins die, you guys.
That's really, that is
95% of them
cold.
are going to tank, you guys. Ha 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 ha.
That is cold. Like that is,
Yeah.
that is not.
Talk about karma.
Yeah, irony. So I want to go back to this question of stable coins. Are the other primaries, whether they're USDC or USDT, at risk from something like this or something that's unseen? Like, and if it was you, in your personal opinion, where do you think is the safest stable coin?
Yeah. So listen, like honestly, there's massive risk right now in the system. If you want to bring up that chart that I showed you of the alpha trends market structure.
That'd be this one right here.
Well, no, this was just one where I was saying that like I kind of
this one. Here we go.
Yeah, this is the one. So this was like back in January of 2021. I was calling it that we were in phase 2.1 of the market structure, which is where we were. I mean, like that was the very beginning. It was clear that like we're right at the beginning of the bull run. And then about a month and a half ago, if you pull up that next tweet that I had where I kind of like reposted that as we are now in 4.2. So that is about, or actually it was about a month ago. What's the date on that tweet?
This would be on March 22nd.
A month ago.
Yeah.
Yeah, or a month and a half. So yeah, like we were pretty much there. I mean, 4.2 is kind of like the mid decline. And then now I feel like we're in 4.3. Like we're headed into this unfortunately long, painful bear market that's going to wipe out a lot of people because like you don't want to be buying rallies in this kind of a market. Like it's too risky. And I think I've been pretty accurate with my calls on the macro structure of the way this market played out. And I've been pretty accurate about like predicting like what's going to blow up and when, not when, and necessarily to the day, but like what's primed to blow up because of the incentives that caused it to grow so big in the first place. And unfortunately, like the way I'm looking at it is like, guys, because there is no central bank of DeFi, because there's no Federal Reserve here to be able to just keep propping this thing up, like in the stock market. I mean, we should have had a stock market collapse and a real estate collapse long ago, but because of quantitative easing, because of quantitative easing and like lots of credit expansion and the Federal Reserve and the Treasury and the commercial banks working together to like make the conditions easy for propping up the markets. Yeah, this is what I said like a month and a half ago as well, that like we had that relief rally and everybody was so excited and they were talking about like ETH's going to flip Bitcoin and Bitcoin's going to 100K and it's like NFTs are going to go off, take off again. I'm like, guys, you guys are kind of like, this is hopium. We're in phase 4.2 of this market structure. We're going down, unfortunately. As much as a long-term bull as I am on Bitcoin, like I'm not selling my Bitcoin. I'm like holding my Bitcoin for my heirs. Like I'm not selling my Bitcoin. So I know that the price is going to crash. I'm a bad trader. So I'm not going to try to trade this crash because I look at everything else in the system and I look at the stock market and I look at the dollar. I look at the problems of money itself. And I don't want to have anything else other than Bitcoin as my frame of reference and my unit of account. So even though I recognize the structure of the market is not good and it's going to be some rough times coming up, especially for people in the really risky stuff like the Jpegs and the DeFi coins, like I'm not selling Bitcoin. I'm just going to keep buying more Bitcoin because in the end, I'm going to get it cheaper. But I like to I'm still going to like be educating people about Bitcoin because I do think it's the most important thing that we can talk about. And it is the one chance that most Gen Zs and millennials have right now of having like a generational wealth transfer, because this is going to end at some point. And well, I mean, the pain, like the bear market is going to end at some point. Maybe it's a year, whatever. But during that year, there's still only about 2% of the world that has access to Bitcoin right now. And Bitcoiners are just like not stopping. Like the hash rate for Bitcoin never went down like for more than a couple weeks in the last bear market. Bitcoiners just keep building. The Bitcoin holder base keeps growing. Even during the bear market, we keep educating people, keep getting the sound information out there. And I don't think that's going to stop again in this market. But for everybody else that's in like DeFi stuff, I think it's going to be a lot more Terra Lunas, unfortunately, because everybody's exposed to the all these strategies. Like Celsius, like I said before, Celsius is a high risk thing to be in right now. Last summer, I was saying that Celsius is a high risk to blow up because of the regulatory risk of their coin, and because they lost a bunch of money in DeFi that they didn't disclose. So like the Celsius coin is down 90% since I tweeted that, and people were calling me a boomer Bitcoiner. Like I'm just like fudding Celsius and all this stuff. I'm like, guys, like their CFO was arrested for fraud. Like this is not just boomer Bitcoiner hating on altcoins. This is like, look at this stuff. This is not valuable. This is high risk.
Mm-hmm.
So
get your shit coins off my lawn.
Get off my lawn, you shit coiner.
Wow. Well, speaking of lawn, we've gone long. Trav, I'm going to toss you the last question here, and then we're going to wrap this up. Make it a good one.
It would seem from this conversation here that, we are in for a long winter, maybe the longest winter potentially, which I would have thought, with all of the inflation and all of the quantitative easing, that the crypto market would it seems to me Bitcoin should be 100 grand right now, if not more, because of the way that money's being manipulated. But it's very clear now that the elite can easily manipulate the crypto markets as well. So where do you think we are, and what is the outlook over these next 12 to 24 months?
Well, I also I should have sent you that tweet too, because I also called the collapse of the stock market, or like the crash of the meme coin, the meme stocks and the tech stocks about 3 months ago. 2.5 months ago, when the Russian sanctions got dropped, I recognized that as like a nuclear bomb getting dropped on the economy and the markets. Yeah. And people weren't really internalizing how serious that was.
It's huge. It's an earthquake to the financial system because now Russia's working with China and Iran and Brazil and all these other countries. Now they think, America can just cancel us from the financial system. Well, guess what? We're not going to be part of that. And now flooding of dollars is going to come back to America, creating hyperinflation, right? We talked about that. This is monumental.
Yeah, well, that's one reason. Like the decline of U.S. hegemony actually is like one of the main reasons, because Ray Dalio has this awesome YouTube video that everybody should watch called "Principles for a Changing World Order." It's like 40 minutes long, but it's really it's
an amazing illustration
produced. Yeah, it's great. But the other thing is that like China and Russia and United States are kind of have been in this like superpower struggle for a while now, and the decline of U.S. hegemony is one problem, but also just like I had described in 2008 and 2008 with like the risk of contagion, like